Welcome to Chapter 23, where we'll be discussing other measurement and disclosure issues. This is the last chapter of Intermediate Financial Accounting 2, so it's an exciting time. Let's get going and get through this last chapter of material. Our first learning objective is to understand the importance of disclosure from a business perspective. Information disclosure is an important part of the capital markets and the allocation of capital. So the information that's disclosed in the financial statements helps the investors assess the relative risks and rewards of investing in a company. The full disclosure principle means that information relevant to decision-making should be included in the financial statements. And you can see in the diagram there's a variety of ways that we can disclose information as part of the financial reporting process. So we've got the financial statements, which is all of our core statements. You can see the statement of cash flow, statement of changes in shareholders' equity, of course, along with the statement of financial position and the statement of income and comprehensive income. Then we've got the notes to the financial statements. And we've got the MD&A and letters to shareholders where companies can provide additional financial reporting, as well as analyst reports, economic statistics, etc. And all of this information together is what investors use to determine whether there's adequate reward to invest in the company. It's important to note that not all disclosure is good disclosure. Not enough information and too much information are equally problematic. So since January 2016, materiality also applies to note disclosures. So obscuring material information with immaterial information makes it become less understandable. So other things to watch for are misleading, selective, and untimely disclosure, as well as any signs for insider trading. And different users may want different information. So it's important to know what the costs and benefits are when we're making decisions about what we're going to disclose. Our second learning objective is to review the full disclosure principle and how it is implemented and explain how companies use accounting policy notes. The full disclosure principle calls for financial reporting of any financial facts that are significant enough to influence the judgment of an informed reader. So the disclosure requirements for public companies are, of course, significantly higher than private, and they've even increased over the past several decades due to the complexity of the business environment, the necessity for timely information, and the use of accounting as a cost control and monitoring device. So of course, requirements for private companies are a lot less. They have a lot less complexity, and they're normally more closely held. So the stakeholders have greater access to information on a day-to-day basis. The cost to implement full disclosure can also be prohibitive. So we really need to be thinking about that cost-benefit disclosure, about the cost-benefit of disclosing information. Now, in terms of disclosing accounting policies are an integral part of the financial statements, and relevant items can be explained in qualitative terms in the notes, and quantitative data may be provided. So accounting policy disclosure should be one of the first notes or in a separate section preceding the remainder of the notes. And accounting policy notes explain the specific accounting methods and principles that are currently used and are considered appropriate for fair presentation of the financial statements. ASPE allows for greater choice and flexibility when selecting accounting policies, and the IASB has been attempting to reduce policy choice in order to improve comparability between companies. What about disclosing accounting errors or illegal acts? Well, that's where it gets tricky. So accounting errors are unintentional mistakes, and irregularities are intentional distortions of the financial statements. So it's really important to note that company management is responsible for ensuring operations are conducted within the applicable laws and regulations, and the auditors also have a role to play in that process. So non-compliance officially means acts of omission or commission, intentional or unintentional, committed by the entity, or by those who are charged with governance by management or other individuals which are contrary to the prevailing laws or regulations. So normally we wouldn't disclose that, but we may have an issue with our audit report. And depending on what the nature of it is, it may be included in some supplementary disclosure. And if there's a material change in the financial statements as a result of an accounting error or as a result of fraud, then that would need to be disclosed. So learning objective number 3, describe the disclosure requirements for major segments of a business. So segmented reporting means that for much investors, a lot of information is hidden in the aggregation of the financial statements. So you might have one entity that does manufacturing and one entity that does mining. If you add those together, it's hard to really understand what's happening with the two different entities. And that's where segmented reporting comes into play. So segmented reporting is required for public entities where we have to disclose those separate segments of the business separately in the notes to the financials. Some companies are reluctant to disclose segmented data. So without understanding the whole business and its environment, the users might find the information meaningless. It could be used by competitors, may discourage risk-taking to avoid segment losses. Investments are in the whole company, not just a segment, etc. And also one of the biggest challenges is that there's obviously intercompany costs that cross those segments, so you'd have to allocate those costs out. So there's definitely some judgment that needs to go into preparing that disclosure as well. Investors do require segmented disclosure to make intelligent decisions about diversified companies. As you can imagine in my example, I've just got 2 segments. Imagine if there's 5 different segments that are completely different. Investors need to understand what's going on with each business. So sales and earnings of individual segments are needed to forecast future consolidated profits, and segment reports disclose the nature of a company's business and the relative size of its components. So segmented reporting has been around for 25 years and it's required by IFRS in certain circumstances, and ASPE does not contain guidance for reporting segment information. So this is specific to public companies. The objective of segmented reporting is to provide information about the different types of business activities and different economic environments so that users can better understand the business's performance, better assess its future cash flows, and make more informed judgments about the business as a whole. The IASB requires including selected information about operating segments from the perspective of this chief operating decision maker. So the management approach is based on the way management sets up the operating segments. And an operating segment is a component of an enterprise that has the following characteristics. So it earns revenues and incurs expenses by doing business activities. Operating results are reviewed regularly by the chief operating decision maker to assess performance, and discrete financial information is available. Information about 2 or more operating segments can be combined only if the segments share the following characteristics. The nature of the products and services combined. So if you have 2 different manufacturing companies, you may be able to aggregate that segmented disclosure. The nature of the production process, the type of customer, the methods of product or service distribution, and the nature of the regulatory environment. And IFRS requires companies combining segments to disclose the judgments made in aggregating segments and a brief description of the segments aggregated. An operating segment is significant and defined as a reportable segment if it satisfies one or more of the following thresholds. So this is how you know if you have to do segmented reporting. Revenue is 10% or more of the combined revenue of all the operating segments. The profit or loss is 10% or more of the absolute amount of the combined profit of those segments. And the assets are 10% or more of the combined segments. In applying the test, we also need to think about additional factors like segmented data must explain a significant portion of the business. A practical limit of 10 segments is enforced, which is great because can you imagine if you had 20 different business segments? And a segment that doesn't meet any of the above criteria can still be presented separately if management believes the information would be useful to users. So A company is a publicly accountable entity. It operates 6 different segments and is preparing segmented reporting disclosures. Information regarding the segments is to the right. So you can see how it's broken out the segments. You can see A, B, C, D, E, F. Those are the different segments. And it's broken out the total revenue and profit and assets of each segment. And it's asking you to determine which of the segments are reportable. So what we need to be able to apply then are those tests, the 10% test. So the revenue test is what's 10% of the overall total. So the overall total revenue across all the segments is 2,160. So 10% of 2,160 is 216. So anything with revenue of more than 216 would meet that test. And so we can see that C, D, and E exceed that amount. Now the profit test, it's 10% of the overall profit. So our profit is $85. So, or the absolute value. So we're gonna that $5 gets added because it's absolute value. So it becomes $90. So 10% of $90 is $9. So which entities have profit greater than $9? Well, everything other than F and B. And then the asset test, 10% of the assets, so we were given the assets of 970. What exceeds the 10% threshold is going to be just C, D, and E. And so those are the reportable segments. So we've got A, C, D, and E are reportable segments across those because they have to meet all of those tests. So segment information is not prepared according to GAAP because some of the principles don't apply. Like, for instance, the allocation of those costs, that's a judgmental thing. But companies need to disclose their measurement choices and the basis for their inter-segment transactions. So what do we have to disclose in addition to breaking down segmented reporting financially? What do we need to disclose in terms of other disclosures? We also need to explain the segments, talk about the revenues and profits, reconcile the segment revenues to the total revenues. We need to explain the products and services, the geographic areas, and the major customers. Learning objective number 4, describe the requirements and accounting problems associated with interim reporting. What's interim reporting? Basically, it's quarterly reporting or some sort of a reporting that's more frequent than annual. And there's 2 different views. There's a discrete view that each interim period should be treated as a separate accounting period, which is preferred under IFRS. And then there's the integral view, which is that the interim report is an integral part of the annual report. So really you have to look at it overall because businesses have seasonality, etc. So notable exceptions to the discrete view are thinking that each period is perfectly separate is income tax is normally calculated only annually, and payroll taxes, the timing of those can often be different and don't match up with the quarters. The same accounting principles and methods that apply to annual reporting, of course, apply to the interim reporting. And at a minimum, a full set of financial statements and selected notes is required. They can be condensed. And statements should present the current period and the interim period year to date with comparatives, and they're restated when changing an accounting policy. And IFRS does not mandate interim reporting. That would be a regulator that would mandate interim reporting, but it does provide guidance if an entity wants to provide it. And if the report is in compliance with IFRS, they should disclose that basis. The minimum disclosure around interim reporting should include whether the statements are in compliance with IFRS, the accounting policies and methods, any seasonal or cyclical period considerations, the nature and amount of unusual items, the nature and amount of estimate changes, and reissuances, repurchases, and repayments of debt or equity securities. Dividends paid, information about reportable segments, subsequent events, changes in the composition of the entity, fair value of financial instruments, etc. So unique problems of interim reporting. Well, when there's a change in an accounting policy, the retroactive application, unless the data is not available, which is a lot of work for interim reporting, earnings per share, each interim period should stand alone. You may still have to provide basic and diluted earnings per share. Seasonality could create wide fluctuations in profits, so it could distort the quarterly results and make them harder to understand. And many auditors are reluctant to be involved in quarterly reporting. The auditor review of interim financial statements in the CPA handbook provides a guidance to auditors. And the purpose of the review is really just to assist the audit committee, but there's not an actual audit report on quarterly reporting itself. Online financial reporting is a new trend where companies aren't mailing out their statements anymore. Now that we're in the 21st century, they're posting them online. So what does that mean? This improves the usefulness of the information. It makes it more accessible across locations and for different investors. The main obstacle is the quality of access to electronic reporting and reliability on the internet. And internet or online financial reporting is voluntary, so no standards require it. Objective number 5, discuss the accounting issues for related party transactions. Okay. Related party transactions arise when a business engages in transactions with another party that can significantly influence its policies. So related party transactions are individually assessed, and they may include the following: companies or individuals with control, investors and investees with significant influence or joint control, company management, members of the immediate family, or other party in the management contract. So if I own a dealership and I want to buy a car and I say I'll pay them $1,000 for the car and they give me a car because I own the dealership and they want to keep me happy, that's a related party transaction. And that's where the actual recording of that transaction can get complicated, because that car that I may have just bought for $1,000 because I am the owner of the dealership might be worth $30,000. So what happens in terms of that accounting? The basic assumption is that transactions are at arm's length, meaning that I would pay fair market value regardless. But if this condition is not met, the exchange value is not necessarily the fair value or the market value. The transaction may have to be remeasured to reflect the appropriate value. ASPE has special measurement principles for related party transactions, and IFRS does not require remeasurement. Under ASPE, economic substance rather than legal form is reported. If the arm's length condition is not met, the transaction should be disclosed as being between related parties. In addition to the accounting, we also are supposed to disclose. We're talking about disclosure here, so that's why you're hearing a lot about what we would disclose in the notes to the financials. So we would disclose a description of the transaction, the recorded amounts, the measurement basis, amounts due to or from related parties, contractual obligations with related parties, and contingencies related parties. And IFRS requires similar disclosures for most related party transactions and balances. Plus, IFRS also requires us to disclose the key management personnel compensation in the notes to the financial statements. Under ASPE, so again, IFRS doesn't require remeasurement. ASPE does. So in that situation I said where I bought a car for $1,000 that was worth $30,000 just because of the nature of my relationship with the dealership, the fact that I owned it, so I have significant influence or control over the dealership. So under ASPE, we would be required to remeasure that transaction. So certain related party transactions must be remeasured to the carrying amount of the underlying assets or services that were exchanged. So the carrying amount is the book value on the transferor's books, so on the dealership's books, after any adjustments for amortization or impairment. Remeasurement happens if the transaction is not in the normal course of business, there is no substantive change in ownership, and the exchange amount is not supported by independent evidence. So where transactions are remeasured to their carrying value, the difference is booked as a charge or credit to equity. So you can see a decision tree here. And again, this is only for ASPE, not for IFRS. So this is a really important difference between ASPE and IFRS. IFRS would not remeasure that related party transaction. ASPE would if it wasn't at the carrying value on the transferor's book. So the dealership that let me buy the car for $1,000. We're asked, is the transaction in the normal course of operations? No. Is the change in ownership interest transferred substantive? No. So then we'd have to remeasure it at the carrying amount because there was no change in ownership. The reason I got that car for $1,000 is because I already own the dealership. It can definitely, if If the transaction was in the normal course of operations, then, and you said yes, you could also come down to this decision tree that says, is the transaction a non-monetary exchange or transfer? So what if I just walked into a dealership and I said, hey, I'm your accountant, I'll do your books for free for 5 years if you let me get $10,000 off of a car? That's a non-monetary transaction. So that's another type of possible related party transaction if the assets are not being exchanged at fair market value. So let's look at an example of related party transactions. A private manufacturing company sells land worth $20,000 to another private company. The companies are related because the same shareholder has 70% equity in each company. The land has a carrying value of $15,000 on the seller's books. In the exchange, the buyer transfers a building that costs $30,000 and has a book value of $12,000. The seller has no contributed surplus. Using the decision tree, assess how this transaction should be accounted for. Well, is this transaction in the normal course of operations? No, because we're exchanging buildings and land, so that's not part of our regular business. Is the transaction in the ownership interest item transferred substantive? No, because the same shareholder owns both assets before and after the transaction, so there's no change in ownership. So we must measure the transaction at the carrying amount. What does that mean? Because there's no substantive change in ownership, the transaction would be remeasured to carrying values by the seller. So the building had a book value of $12,000. So that's what we would record it at. And the land had a book value of $15,000. So the difference would be recorded through $3,000. For the seller, the buyer would record the land at $15,000 and take the building and accumulated depreciation off the books. Let's look at another example. Assume the same facts from example 1, except the exchange was made in the normal course of business and had commercial substance. The parties decided the appropriate exchange value would be $20,000. So is the transaction in the normal course of operations? Well, yes, because they just told us that it was. Is the transaction a non-monetary exchange or transfer of a non-monetary asset? Yes, because we're swapping buildings and land. We're not trading money. Is the transaction an exchange of products or property held for sale in the normal course of operations? No. Does the transaction have commercial substance? Again, yes. So now we're going to measure the transaction at the exchange amount. So previously we were measuring the transaction at the carrying value. Now we're measuring the transaction at the exchange amount. So the transaction should be treated like a sale. So the seller would recognize a gain of $5,000 because they got a building worth $20,000 and they gave up land that was worth $15,000. And the buyer would recognize a gain of $8,000. So they gave up land that was worth $20,000, but they got a building that had a net book value of, what is that? 30 minus 18. I can't do math in my head. 12,000. So then they had a gain on disposal of 8,000. So they got the land for 20,000. They gave up the building that was worth 18,000. Is that right? 30 minus 18? No, 12,000. Sorry, 12,000. Got land of 20,000. Give up building for 12,000. Had a gain of 8,000. Of course, that math makes sense. All right, and that is the conclusion of the part 1 tutorial or the part 1 lecture. Please join me in the tutorial section and we'll go through a couple questions.